I've grown my investment portfolio to just over £500,000, but one of the most common questions I get is how much would my portfolio be worth now if instead of investing in UK shares, I had invested just in the S&P 500. In this video, I will look at what my portfolio would now be worth if I had invested in a range of different assets. This is not investment advice, and historical performance is no indication of future returns. I've been investing for almost 16 years. I made sure my mortgage was paid off before I started, so I could concentrate solely on growing this portfolio. I like to fight one battle at a time. Firstly, let's look at what my portfolio would now be worth if I simply shoved it all under the mattress and kept it as cash. Over the last 16 years, I've put away an average of 1.4k a month, and stuffing that under the bed would amount to a grand total of around £270,000. However, that would not have been such a great idea, since inflation would have eroded the actual purchasing power of my capital. They say investing carries risk, but you have to ask yourself, is it actually more risky not investing? I've looked at the average yearly inflation rate over the last 16 years, which is 2.7% per year. But it did of course fluctuate. But when this is all taken into account, my £270,000 under the mattress would now be worth £210,000 in real terms. Let's plot the actual amount of 270k on a bar chart so we can compare to other assets. So how about a savings account? How much better would this have done? Well, I know different savings accounts give you different rates. The one I use is my National Savings and Investment Direct Saver account, and over the last 16 years the average yearly interest rate was 1.5%. Using this, my £270,000 would now be worth £307,000, but remember, we would still be losing to inflation, which was an average of 2.7% over my investing journey. So putting all my money in a savings account is not going to build wealth either. Okay, so what have I actually been doing with my money over the last 16 years? Well, let's go back to the beginning. Way back in 2009, when I started my portfolio, there was not a vast range of platforms available as we have today. No commission-free apps, and fractional shares were not even a thing. I chose Barclays in the end, but there was not a lot of choice. It cost me £12 for every trade I made, however large or small, and don't forget stamp duty. If I used a strange contraption called a telephone to make a trade, it was nearly £30. There was even an inactivity fee to pay if I didn't trade often enough. If you think that was bad enough, then the worst news is about to come. I was not allowed to buy individual overseas shares on my platform. In fact, Barclays only changed this policy about 3 years ago. In 2009, exchange-traded funds were not mainstream either, and I hadn't even heard of them until many years later. So I grew accustomed to buying large UK companies. More recently, however, I've started buying a range of ETFs from around the world, but I'm still around 80% in UK stocks. So how have I done? The calculations are quite complex since I didn't put the same amount in each month. As I said before, the average was just over 1.4k a month. Using a compound interest calculator, inputting a yearly total return of 7.1% actually gets me very close to the actual value of my portfolio today, which is just over £500,000. If you want to keep up to date with what I buy and sell, as well as my portfolio updates, then just hit the subscribe button. It's absolutely free. So I've clearly beaten inflation, but what would my portfolio now be worth if I had invested into other things instead? What if I had put all of my money into a FTSE 100 ETF rather than picking individual shares? Well, this would have given me an annualized return of 6.8% a year and a current value of £489,000. So according to my compound interest calculator, I have managed to beat the FTSE 100 in total return over the last 16 years. But this is where the good news ends, and you are about to see with the benefit of hindsight how much more certain other assets in that same time period could have earned me. Yes, we are all wiser in hindsight, and I'm just showing you my own journey. What if I had invested in gold? Let's see what would have happened if instead of investing in the likes of Unilever, National Grid and GSK, I had just bought gold coins every month and shoved them in a safe. But why would someone invest in gold? Well, first of all, it's pretty scarce. All the global gold ever mined would be only 1 metre high if spread across a football pitch. Gold can be a safe haven asset and protect you from market downturns. Investors often buy gold to protect their savings in the event of a market crash. For example, the price of gold went up by more than 100% between 2008 and 2012, the height of the financial crash. As nearly all other assets lost money, demand for gold grew because of its perceived reputation for safety. Some believe it's also an insurance against inflation, but in reality the link between the gold price and inflation is not actually that strong. It's more of an insurance against hyperinflation. Gold is another asset you could add to your portfolio beyond traditional stocks and bonds to increase diversification, as it's unlikely that every asset will suffer from the same market conditions, allowing you to minimize losses. In theory, the more diversification, the better. So what about the downsides of owning gold? Gold does not generate income. The only way to make money investing in gold is if the price goes up. Other investments provide income in addition to gains from price appreciation. For example, stocks earn dividends, bonds earn interest, and real estate investments earn rent. There could be hidden costs in storing and transporting physical gold, and you may need insurance to protect against theft. Keeping a large amount of gold at home is risky, and storing it in a safety deposit box or in a bank vault will incur costs that will reduce your overall return. Finally, there are higher taxes. The long-term capital gains tax on gold is 28%, which is significantly higher than for stocks or bonds. A more efficient and safer strategy might be to invest in gold ETFs. If I had invested in gold right from the start, I would have achieved an annual return on investment of 8.5%. My portfolio would now be worth £578,000, and I would be better off by £73,000. Now, what would my portfolio be worth today if I had drip-fed everything into a typical all-world index tracking ETF right from the start? A typical example of an all-world ETF is Vanguard's VWRL, which gives you exposure to over 3,600 companies from around the world, all in one share. This screen shows some of the largest companies you would own if you invest in something like VWRL. It also pays a small dividend of 1.6% per year, and the ongoing annual charges are 0.22%. If you really don't know what to invest in, or just haven't got the time to pick and choose, then many investors simply buy something like this and hold for the long term. So if I had taken this approach way back in 2009 and invested spare money each month into such an instrument, my annual return on investment would have been 10%, and my portfolio would now be worth £660,000, making me better off than I am now by £158,000. Oh, the joy of hindsight, but remember, I had not even heard of ETFs back then. If you want to invest in index tracking ETFs or even individual shares, then Trading 212 will start you off with a free fractional share worth up to £100 if you sign up to their platform. Just click on the link in the video description. Terms apply. Now for the one many of you have been waiting for. What if I had invested all of my money into the S&P 500 throughout my entire journey? How rich would I be today? A typical ETF which gives you exposure to the largest 500 companies in the US is IUSA. Here are the largest companies you would own. This particular ETF pays a small dividend of 1.1% spread over 4 payments a year. But as with most index tracking ETFs, there are some which don't pay a dividend, and in effect it all gets reinvested. Ongoing charge of this one shown here is tiny at 0.07%. So if I had simply invested any spare money each month into an S&P 500 ETF, I'd have seen an annual return on investment of 15%, and my portfolio would now be worth over £1 million, which is more than double what it is today. But that's nothing compared to what I would have made if I'd invested in the NASDAQ. The NASDAQ Composite Index is made up of 2,500 companies in the global technology sector. This particular ETF here is provided by BlackRock and gives you exposure to the largest 100 companies in the NASDAQ index. And here are some of the largest. Ongoing charges are 0.33% a year. If I had somehow invested in the NASDAQ index all those years ago and ignored everything else, then I'd be looking at a 23% average annual return, catapulting my portfolio to a value today of £2.5 million. And I would have been around 5 times better off than I am today. If you are enjoying this video, then please give that like button a quick tap, as it really helps out the channel. Now, long before I started my portfolio in 2009, one of my main hobbies was building computers. And it still is if you check out my community tab. And guess what company made all those graphics cards I used to buy? They were made by Nvidia. Yes, I knew a lot about Nvidia even before I started investing. Nvidia is now the largest company in the world by market capitalization, and its chips are in high demand for applications such as artificial intelligence. So what would I now have if I had just put everything into Nvidia shares? The average annual return would have been 75% throughout the duration of my portfolio, and it would now be worth £768 million. But who would have known that Nvidia would have done so well back then? It is also very risky investing in single companies, and you could of course lose everything very quickly if the company went bust. Never put all your eggs in one basket. We all know what happened to the likes of Kodak, Nokia and BlackBerry. While we're on the subject of technology, what if I had invested in Tesla all those years ago? I don't think Tesla needs much of an introduction. The shares were floated in 2010, so I would have had to wait a year before being able to invest. Despite waiting a year, I would still have received an average annual return of 90%, which would mean my portfolio size would now be worth an incredible £3.6 billion. But who would have known that Tesla would have done so well? And remember, my Barclays platform did not even allow me to buy individual overseas shares until about 3 years ago. Nobody knows for sure what will happen in the long run, especially where individual companies are concerned. Historical performance is not a reliable indicator of future returns. An example of that is in 2021, a UK electric vehicle company called Arrival was valued at £9 billion. But just 3 years later, Arrival collapsed into administration, leaving shareholders with practically nothing. So what are my overall conclusions from this video? Firstly, we're all geniuses in hindsight. If we just had access to tomorrow's newspaper today, we could all be millionaires, but we don't. And tomorrow's next big thing is probably here today, but nobody is talking about it. Or perhaps they are. We just don't know. Coincidentally, Bitcoin was launched in January 2009. In the very same month, I started investing in my own portfolio. Buying Bitcoin right from the start would have generated the greatest returns of all, but I consider that speculating rather than investing, and I hold no cryptocurrency in my portfolio at all. So to summarise, my portfolio return has beaten inflation so far and has even performed well when compared to the FTSE 100 index. But it does look quite disappointing compared to some of the examples we've looked at today. But I'm okay with that. I've made plenty of mistakes, especially in the early days when I was learning, and my results include everything. I'm still hopeful I'll achieve financial freedom. I definitely haven't picked the best shares or even adopted the most efficient investing strategy. But what I have done is put money in on a regular basis across a range of different sectors for a very long time, and I've simply stuck at it. To use a cricketing analogy, I'm not trying to hit sixes from each ball. I'm simply going for single runs and hoping to stay in forever. As I have already mentioned, it took me several years to even know what ETFs were, but I now believe they are a great way to diversify my portfolio and to reduce risk. If you want to know exactly what's in my portfolio and how it's performed, then click this video here. See you next time and happy investing.